How much time do you think it takes to calculate a new business idea? 2 weeks or even more? No. I can guarantee you that your first calculation can be done in 20 minutes or less. And it's not as painful as you might think. Hi, I'm Felix, and I work together with hundreds of clients, large and small, over the past 7 years, helping them to create innovative businesses. I know that many people have great business ideas in their heads, sometimes even for years, but they never execute them. Maybe you're one of them. You don't like your current corporate job and you have this crazy idea, but you don't know how to get started. You simply don't know if this can work out financially. From my experience, many people are afraid to do a financial calculation because they think it's a lot of effort. Many people think that a financial calculation takes a lot of time, is hard work, and in the end is worthless since it's all built on fantasy numbers. In this video, I will take away all your fears that you might have. I will give you the exact same calculation method that I used not only for all my businesses in the past, but also with multiple clients with tremendous success. I first discovered this method in an article called Discovery-Driven Planning, written by the professors Rita McGrath and MacMillan, that was published in the Harvard Business Review. And the main benefits of this calculation are: you know exactly what cost figures you must research. You know exactly what to test, for example, the exact price people have to be willing to pay for your product. And you know exactly under which circumstances your idea will be profitable and when not. On the other hand, if you don't make a calculation of your business idea, you will never take action, since your idea is nothing more than a pipe dream. And other people, like friends, family, potential co-founders or investors, will never take you seriously and support you. Therefore, I can only recommend this simple calculation. If you want to do this calculation by yourself, click the link in the description below and you'll be guided to a webpage where you must enter your email address. Afterwards, you will get an email with a link to the Google spreadsheet. So let's get started. The basic idea behind this method is to do the calculation in reverse. Therefore, you start with the question, how much profit do you want to make? And then you work your way backwards to see under which assumptions this profit is achievable. Okay, so this is the reverse calculation spreadsheet. And what you see here on the left is the calculation steps. Then you see further questions that help you, especially when you do this calculation by yourself for your business. And here in the values column, this is where you have to enter your values, where you have to calculate your business, your business idea. And in the last column, you see the type of value. For example, it can be a management decision or an assumption or just a calculation. Okay, so with no further ado, let's get started. The first question is, what are the required profits? So this is also the reason why the reverse calculation have its name reverse calculation, because we start with the profits. What you typically do is you make a lot of assumptions and you make a calculation for year 1, year 2, year 3, year 4, year 5, and finally your business becomes profitable. Maybe after 3 or 4 or 5 years, you have this moment which is called the break-even moment, where you have more revenues than you have costs. And then your company makes a profit and your profit is the result. Not here. So since we know that 99% of all business cases work like that, we can turn it around and say, okay, what is the profit? Because this simplifies a lot. So we don't need to make all the whole calculation for all the other years. So we just say, what assumptions have to be right to make this profit achievable? And this makes it so much easier and also more straightforward, because in the end we don't need to care too much about the whole calculation for 5 years. We only need to care about the assumptions that have to be right anyways. Otherwise it will not become profitable. That's why you start with a number here. That can be 0 when this is a not-for-profit business. That's also fine. It can be $100,000. It can be $1 million.
$1 million.
It can be more than $1 million, so this is really up to you. Just keep in mind, this is just after the break-even, basically your first or second year after this is a profitable business, and it also shows your financial ambitions. Yeah? Do you want to make it highly profitable, or take it slow, maybe make it a non-profit? For this example, I will use $100,000. So we just say the currency is dollars here. It's a $100,000 in profits that we want to make after this became a profitable company. Next step, return on sales. So this is the ratio between profits and revenues. It also means your profitability, your profit margin. And this can be very different when you look into industries like retail, for example, supermarkets, that it maybe have 1 or 2 or 3% return on sales. In other industries, maybe Google, for instance, they have 20-25% return on sales. And then there are maybe some consulting businesses that maybe make 30 or 40% return on sales. So this is very different depending on which industry you're in and also what's your business model. So for this example, let's say we have only a return on sales of 10%. That means to make 100,000 in profits, we have to make 1 million in revenues. It also means that we have allowable costs of $900,000. Now this is really important here. We will use that number later because this will tell us if the whole business model will work or not. Okay, so the next thing is to discuss the revenue streams and what is basically our source of income. How do we want to earn money? And this is really different depending on what idea you have. You might sell hamburgers, or you might sell cars or phones or software or hardware. It can be anything, right? And it's also about the logic. Do you earn money per minute or per hour or per piece? Okay, so here is your space to explain this. What's your revenue model? And for this example, let's say we have a software subscription that we sell to other businesses. Yeah, we have a software subscription and they pay us on a yearly basis a price. And maybe also we have a software product that they only buy once and then they can use it. And maybe this is also kind of our foot in the door of the customer, that we have the software product, and then after using the software product for some time, they say, okay, we need a subscription. Let's assume that's the idea here. Okay, so we have a software product and a software subscription. What's the revenue split? So when you have more than one revenue stream, you have to discuss what's your revenue split. You have to make an assumption here. Don't do more than 2 revenue streams or income streams for now, because of course you can do more, but it also will make your life much harder, also in reality, not only for the calculation. Of course, the calculation becomes more difficult, but also when you start a new business. Think of Amazon. When they started 25 years ago, they had only one revenue stream. This was selling books online. And now they have dozens of revenue streams. Typically, the bigger the company grows, the more revenue streams you have, but for the beginning, keep it simple. So when you have 2, in our example you have 2, you can also do 1. You have to make the split, let's say 80-20 here. It has to be 100 in total. So that's our split, and this just tells us that this revenue stream has to make 800,000 in revenues, and the other revenue stream has to generate 200,000 in revenues. Okay. And now we have to define the price per unit, whatever the unit is. You have to find the unit when you say, okay, it's a subscription, or it's a burger, or it's, I don't know, whatever it is. Okay. So what's your average price for this unit? Let's say we have $100 that we charge for an annual subscription. It's per year in this case, okay? And for the software product, we sell it only once. Let's say it's a cheap product. It's just $20, okay? Now we know the number of units we have to sell. The number of paid subscriptions, for example, we have to charge per year. But this doesn't mean we have to have these number of customers, because sometimes a customer buys more subscriptions or buys more pizzas a year, okay? So it can be that one customer buys not just one unit, it buys several units. For example, when you sell a software subscription to small businesses, your clients are small businesses, maybe on average, each small business buys 10 subscriptions. There could be. But maybe they buy only one software product because they can use the software product for all people in the company whatever the reason is. Okay, so let's say we have these number of customers that we need to have per year, let's say in year 5, to become a profitable company or to be a profitable company that makes this 100,000 in profits. It doesn't mean we have to acquire 800 people per year to become profitable. No, we only need to acquire new customers. And we have new customers for 2 reasons. One reason is we lose customers. Every business loses customers, right? When you have a subscription, sometimes people cancel the subscription. Maybe they don't use it anymore, or they find a better service from a competitor, or they're just not happy, or they shut down their business. For whatever reason, you will lose customers. Let's say we have a 40% churn rate. So this is the term here. The churn rate explains how many customers you lose. And the other reason is your growth rate. You want to grow your business. When you have more customers next year, you need to acquire more customers now. So let's say we have a growth rate of 30%. This is already a quite low growth rate, because you have to think about it. This is after you have this hockey stick curve, and this is the moment after the company became profitable. So it has to grow. Typically, it has to grow to become profitable. And sometimes this can be 100% growth or 200% growth. So 30% growth is already a very conservative number here. And this tells us that in total, we have to acquire 70% of these 800 customers. And we see this is 560 customers in total. And for the software product, let's assume we lose 100% of our customers, because we have designed the product that it doesn't make sense to buy it every single year again. You just buy this product once and then you don't need it to buy it again. So that's why we lose 100% of these customers. But we also want to grow it. Let's say it's also 30%. So that means we have to have 130% new customers. And now we discuss customer acquisition costs. So many people still think about marketing budgets. Yeah, marketing budgets are good and fine, but when you say we have 2 million for marketing, it doesn't explain how much money you spend per customer that you want to get. And this can mean that you're spending too much or too little per customer. When you spend too little, you don't acquire enough customers. When you spend too much, you might lose money with every single customer. That's why it's much better to think about customer acquisition costs. You also have to make assumptions about a customer lifetime value. I will not do this now in this calculation, but later on you have to do this. In the end, your customer acquisition costs have to be lower, probably 3 times lower than your customer lifetime value. So the money that you earn with one customer over its customer lifetime needs to be 3 times higher typically than the customer acquisition costs. But this is something I will probably explain in another video. For now, just think about it. How much money do I have to spend to get a customer? Let's say this is just $20 and $20. Yeah, we spend $20 that somebody buys the software product, and then maybe you spend another $20 that they upgrade maybe to the subscription. And this is what we spend then in total for our customer acquisition costs. And then we have other direct costs per unit. Okay, so with direct costs per unit, they're very low when you have a software product. Yeah, typically when you have a physical product, they are much higher. Yeah, think of a physical product that you maybe sell through Amazon Marketplace, and then you have a fee for Amazon Marketplace, but you also have production costs, you have maybe costs for the raw material, you have delivery, logistics costs, you have all these different cost factors, and then your direct costs, so the cost that you have with every single unit that you produce and ship to the customer becomes quite high. Not with a software product, especially not with a subscription. So let's say it's just $10 maybe for some credit card transaction fees, and maybe $2 for the software product. So let's say our direct costs per unit are quite low because it's very digital. And very digital means it's very scalable, and we like scalable businesses. But of course, this calculation also works when you have high direct costs per unit. And now we come to the last part, the total indirect costs. And indirect costs are basically the overhead, or other costs that you have for your organization. And the way to do it is to make a list, like a list with bookkeeping, a lawyer, you maybe go to a trade fair, maybe you are the CEO and you want to have a salary, and maybe some other people that are not directly involved with producing and selling a unit. And then you make assumptions, how much annual cost would that be? Maybe this is 10,000 for bookkeeping, maybe another 5,000 for the lawyer, whatever it is. So you make this auxiliary calculation, and then you make a sum and you say, okay, that's the amount of money I need to spend for the whole organization, for the overhead, what I assume makes sense to spend this amount of money, or that I need to have this budget for this. And then you put it here. The way not to do it is to look at the cost buffer and say, okay, we have a cost buffer of 500,000 left. Let's spend this money on the indirect costs. Because then you do the reverse of the reverse calculation, and you basically shoot yourself in the foot, so to say. Do it what I explained. Make this calculation, add it up, and maybe you end up with $600,000. Okay, let's assume it's 600,000, and now you have a problem. Yeah, because now when we add all these costs together for customer acquisition, all the direct costs in total, and the total indirect costs, we end up with $970,000, which is higher than our allowable cost of $900,000. And if our anticipated costs are higher than the allowable costs, that means we have a problem, because we have a negative cost buffer. So it just means that in theory, this business idea will not work. But that's not the end of the day. So you can change all the numbers. Maybe my return on sales was too high. Maybe it's only 7%. And then see what happens. And when it's 7%, you have much higher allowable costs. So you already see here with higher allowable costs, you have already a positive cost buffer. But you can also change all the other numbers. You can change your prices. You can see what effect your direct costs or customer acquisition costs have. So really go through this calculation very quickly in your first iteration, and then change and play with the numbers, and then the result is you see exactly what are the important assumptions you have to make, and these are the assumptions that you have to test later on. Make your first iteration of this calculation in less than 20 minutes, and then change and adapt the figures until you reach a decent positive cost buffer. Decent would mean about 10 to 20% of your expected revenues. This positive cost buffer gives your calculation a little bit of robustness, since in reality things always tend to be more costly and everything takes longer. So whenever you have a new business idea or you want to change your current business model, make this simple calculation, because this tool forces you to make many important financial assumptions you have to make anyways, including 3 of the most important ones, which is what are people willing to pay for your product, your customer acquisition costs, and your direct costs per unit. Now you can go out and turn your assumptions into facts. This is the beauty of this tool. Since you're spending very little time on your whiteboard calculating your financials, you have more time to go out and test and validate your assumptions. As you can imagine, I put a lot of effort into creating all this. Therefore, if you want to say thank you, just click the like button and subscribe to my channel. If you're already a subscriber of this channel, just say hi in the comments. Thank you for watching, and I'll see you in the next video.